The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had.
Are you looking to invest like one of the most successful investors of all time? Look no further. In this video, we're going to take a deep dive into the investment strategies of Warren Buffett and his Berkshire Hathaway empire, and show you how to apply these strategies to your own portfolio for long-term success. So, whether you're new to investing or a seasoned pro, this video is for you. Get ready to learn the secrets of Warren Buffett's investing success and start maximizing your returns today. First, let's talk about the basics of Berkshire Hathaway. The company was originally a textile manufacturer, but under Buffett's leadership, it shifted away from the textile industry and evolved into a holding company that owns a diverse portfolio of subsidiaries and investments. Some of the most well-known companies in the Berkshire Hathaway portfolio include Coca-Cola, American Express, and Wells Fargo. These are all companies that have contributed to Berkshire's impressive year-over-year return of 20.1% over the last 56 years. One of the keys to Buffett's investment strategy is his focus on investing in companies with strong fundamentals. He looks for companies that have a durable competitive advantage, often referred to as a moat. This can take the form of a strong brand, patent, or other factors that give the company a sustainable edge over its competitors. These moats can take different forms, but they all provide a barrier to competition that allows a company to generate high returns on capital for an extended period of time. Some of the things that Buffett looks for when identifying companies with moats include 1. Strong brand. Companies with strong and well-known brands, such as Coca-Cola or American Express, can often charge higher prices for their products or services because customers are willing to pay a premium for the brand. 2. Network effect. Network effect refers to the phenomenon where a product or service becomes more valuable as more people use it. Companies like Facebook and Visa have a network effect as they become more valuable to users as more people join their platform or use their service. 3. Cost advantages. Buffett looks for companies that have a significant cost advantage over their competitors. This could be due to companies of scale, access to low-cost materials, or other factors. 4. Patents and intellectual property. Patents and other forms of intellectual property can provide a barrier to entry for competitors and allow a company to charge premium prices for their products. Pharmaceutical companies, for example, rely heavily on patents to protect their drugs. 5. Regulatory barriers. Certain companies have business models that are protected by government regulations, for example, utility companies. 6. High switching costs. Companies with high switching costs can be challenging for customers to change service providers. For example, software companies that have customers who have integrated their software into their systems and processes.
The most important thing what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. We are trying to figure out why is that castle still standing? And what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now? What are the key factors and how permanent are they? How much do they depend on the genius of the lord in the castle? And then if we feel good about the moat, then we try to figure out whether the Lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses.
It's worth noting that finding companies with economic moats is not always easy, and not all companies have them. Buffett and his team at Berkshire Hathaway spend a significant amount of time researching and analyzing companies to identify those that possess a sustainable competitive advantage. Another important aspect of Buffett's investment strategy is his focus on the long term. He is not interested in chasing short-term gains, but instead looks for companies that will be successful in the long run. This is reflected in his famous quote, "Our favorite holding period is forever." One of the most well-known examples of his long-term focus is Berkshire Hathaway's investment in Coca-Cola. Buffett first invested in the company in 1988, and it has been a staple of the portfolio ever since. In Berkshire Hathaway's 2018 annual letter to shareholders, Buffett wrote, "Coca-Cola has been a wonderful business. People are not going to stop drinking Coca-Cola."
1930, real GDP per capita in the United States has gone up 6 for 1. Think of that, 6 for 1 in one person's lifetime. We have not lost the secret sauce. So that's the kind of future I see ahead too. And if that's the future, you want to own businesses that are going to participate in that future. And we've done that for decades now at Berkshire Hathaway, and we'll continue to do it.
Another example of Buffett's investment strategy in action is his investment in American Express. In 1964, Buffett purchased shares in the company after the stock had fallen following a scandal. He saw the potential for the company to recover and grow in the long term, and this bet paid off handsomely, with American Express becoming one of Berkshire Hathaway's most profitable investments. It is also worth noting that Buffett and his team at Berkshire Hathaway have a strong preference for investing in domestic companies, and they rarely invest in emerging markets or international companies. So, how can we apply these investment strategies to our own investing? One way is to focus on investing in companies with strong fundamentals and durable competitive advantages, what Buffett describes as moats. This will take some research and due diligence on your part, but it will help identify companies that are more likely to be successful in the long term. Another way to invest like Berkshire Hathaway is to focus on the long term. This means not being swayed by short-term market fluctuations and instead holding on to your investments for the long haul. This can be difficult as it can be tempting to sell our investments when the market is down, but by staying the course and holding on to our investments for the long term, we give them a better chance to grow and prosper.
We're almost always a buyer of stocks over time. I mean, I have no idea where they're going to be in 10 days or a year or 2 years, but over time we'll do very well. America, you can't really miss with America. We've got the secret sauce, and it doesn't work all the time perfectly, but you just look at where we go milestone after milestone, and never bet against America.
It is also worth noting that Berkshire Hathaway's portfolio is somewhat diversified. Warren Buffett recommends diversification for anyone who isn't 100% certain of their own abilities as an investor. However, if you wish to achieve significant returns, you're going to have to narrow down your portfolio to a smaller number of stocks. This follows with extra risk, but Warren Buffett recommended anywhere between 20 to 50 stocks. I have to note that achieving the same level of success as Warren Buffett is not easy, and not many have been able to replicate his success in investing. It's important to have realistic expectations and not to aim for unrealistic returns. Always remember that investing always carries risks, and one should never invest more than they can afford to lose. So, if you wish to invest like Berkshire Hathaway, you're going to need patience, discipline, and a long-term perspective. By focusing on companies with strong fundamentals and a durable competitive advantage, you'll increase your chances of success in the stock market.